Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this Peak Prosperity Podcast. It is August 31st, 2017. I am your host, Chris Martenson. Hurricane Harvey has flooded an immense stretch of the Texas and western Louisiana coasts. The situation is still developing, and we do not yet have anything close to a complete accounting of the damage, let alone when repairs might begin, how long they'll take, or what the costs will be. Of vital importance, however, to everyone in the U.S. as well as global energy markets is the impact Harvey has had on the petroleum extraction and refining industries that are absolutely crammed into the bullseye of Harvey's wrath. Will there be shortages? Will transport fuels like gasoline, diesel, and jet fuel spike in price? How can we begin to understand these complex and very important issues on that front to help us understand and appreciate the importance of export quantities? We have Jeffrey J. Brown back with us today. Jeffrey is a licensed professional geoscientist responsible for the discovery of several oil and gas fields in West Central Texas and currently managing an exploration joint venture. He's authored numerous articles with a special emphasis on global oil exports. In 2006, Jeff first proposed a simple mathematical model for oil exporting countries called the Export Land Model, or ELM, which I featured in the Crash Course video series and book because it's essential to understanding the future of oil. I think the model has some insights for us here today as we try and unravel the complexities of the U.S. refining and distribution system in our search for clues as to what may unfold in the near future. Welcome, Jeffrey.
Thank you very much. I'm happy to be on your podcast today.
Well, thank you. Yeah, first, you're in Dallas. How did you fare there, and have you noticed any impacts all the way up there from Harvey so far?
We began to see the first impacts yesterday, and it's really beginning to hit full force today. Several gas stations out of gasoline and long lines at several others. One of the principal companies, Quick Trip in the area, is basically doing a triage operation. They announced they're going to cut off gas to half of their gas stations on Labor Day weekend and direct the remaining fuel they have to select ones on a scattered area across the Metroplex. Basically, they found that in a gas shortage situation, if they tried to keep every station supplied, everybody ran dry. So they're basically doing a triage operation. But it's certainly hitting with full force right now.
Well, I'm sorry to hear that, but not unanticipated, not surprising, as you and I exchanged in an email string a few days ago. You were expecting regional shortages to develop as a consequence of what happened down there.
Yes, I had a little email correspondence with the Wall Street Journal reporter, and I kind of took issue with a statement they made that we had roughly 24 days of supply of gasoline in inventory. And I pointed out the critical mistake they're making was not accounting for the minimum level of inventory we need to keep the whole system running. Pipelines, tanker trucks, terminals, etc. There's a good deal of gasoline that's always in transit, that's counted in inventory, but it's not usable. And the various numbers I've heard are between 170 and 185 million barrels is a minimum operating level. And I think a few years ago, the Congressional Research Service put the number at 185. But as of last week, we had 230 million barrels in inventory of gasoline. And in round numbers, they were basically producing about 10 million barrels, more or less. So we only actually have roughly 45 million barrels of gasoline above minimum operating level. And so, for the sake of argument, let's say the inventory drops by 10%, drops by 23 million barrels. Well, it's only a 10% reduction in inventory, but that would wipe out roughly half of the available inventory.
So this is an important point, Jeffrey, which you directed me to a Tom Whipple article from 2007 that he wrote about this. And what he wrote in there was, he said that the next important point about gasoline stockpiles is not that all of it is usable. As gasoline is largely delivered by pipeline, barge, and coastal tankers these days, a lot of the gasoline, hey, it's tied up in transit. Thus, the amount of gasoline trapped in transport is substantial. This trapped gasoline is known as the minimum operating level. So let's take a pipeline. This seems easy to understand. The pipeline is a tube. It's got a volume. There's gasoline in there. I guess they count that, the amount of gasoline in the tube, as part of our inventory. For the sake of argument, let's say there's 20 million gallons filling a pipeline. You can't use that 20 million gallons. You'd have to put a gallon on one end to get a gallon out the other end. Is that the concept here?
Correct. Yeah, it's you basically have to, prime the pump, so to speak. You've got this base cushion level inventory that is always necessary simply to keep the system running. And the implication of the Wall Street Journal article was we've got nothing to worry about, because even with zero refinery output, if every refinery in the country was shut down, we've got gasoline for 3 weeks. And I said no. I said we're gonna see spot shortages very quickly, probably in a few days. And in fact, that's basically what's transpired here, and I guess probably throughout Texas, but certainly here in North Texas.
Well, let's help people understand the complexities of this, because for most people, their experience with gasoline involves a credit card and a pump handle, and that's how it works. But when we look at the EIA reports, they break down gasoline into regions of the country. So California is a region. I guess they call them PADs for some reason, but East Coast is a region. So these regions have their own supply and demand balances. And so what you're noticing down there in Dallas is already, even though you're in the heart of petroleum country, refining country, all of that, that somehow that local region has already suffered. It's fallen below, obviously, the minimum operating level if you're already triaging. Is that a fair way to look at it?
Correct. There, I think roughly somewhere between probably 25-30% of the U.S. refining capacity is currently offline. But what that means for Texas is, I suspect, somewhere between 60 and 80% of Texas refining capacity is currently offline. So it's an enormous reduction in output. And matter of fact, the big Colonial pipeline that transports diesel, jet fuel, and gasoline up to the East Coast partially shut down yesterday, and I think they're totally shutting down today.
And they're doing that because there just isn't the feedstock coming out of refineries to fill it and move it. Is that a correct assessment?
Correct.
Yeah, so the pipeline itself is fine, but it just doesn't have product to put in there. And I did read an article where they were soft pedaling it again in the Wall Street Journal, I believe, or this might have been Bloomberg. I can't quite remember now. But basically they found somebody to say, it's okay. If the Colonial pipeline shuts down, all is not lost. We can still get gasoline up to the Northeast using trucks, trains, and barges. And I thought, well, if you don't have it to put in the pipeline, what are you putting in the barges? I was confused. So is there a possibility here that there are other stockpiles that somehow don't tie to the pipeline that would be available?
Well, certainly I don't think so from the Texas area, maybe some in Louisiana, and they may be talking about moving gasoline from the mid-continent. And the EPA has gotten rid of their restrictions on boutique gasoline blends. As you know, you've got these boutique blends for specific areas based on air quality considerations. I think they've abolished those, so they can easily transport gasoline from one part of the country to another part of the country. Now, on an optimistic note, so far I don't think we've seen any reports of serious long-term damage to refineries. So this should be a fairly transient situation. On the other hand, I think the Beaumont-Port Arthur area is probably hit even harder than the refineries in Houston. I think the New York Times said that Houston, or Harris County, where Houston is located, was 25 to 30% flooded to an average depth of about 33 inches. But the mayor of Port Arthur this morning said that they had 100% flooding in Port Arthur, every single house in Port Arthur had some degree of flooding. And I think the refineries are actually flooded themselves in Beaumont, Port Arthur. So that may be a somewhat longer recovery time than what we're going to see in Houston and Corpus Christi. But I think they're initiating startup procedures in Corpus, where the storm hit first.
Right, but I believe the storm came ashore to the east of Corpus Christi,
Correct.
So they weren't on the bad side of the eye wall, as it were.
Correct.
Yep. All right. So good to hear that those are starting up. But I want to just confirm for you that I also heard just what I could through the news that the Port Arthur area just really got walloped very, very hard. The announcements that were coming out from the officials in the rescue and Office of Emergency Management, all those officials, it was really dire yesterday. They just said, every man for himself. We can't respond. We're having to, we can't get out there till, nightfall is over and all that other stuff. So it sounded pretty dire. I haven't seen any reports yet, but we do know that all the way up where the Arcana plant was, which is very far north of there, they had 6 feet of standing water there, which was enough to obviously scuttle that plant and take out all of its backup generators and whatnot. So my understanding is, refinery is a very complex piece of equipment. Shutting it down is not easy. It's not done lightly, and starting it up is not as easy as just saying, well, we turn the switch and on it starts again. There's a whole procedure there. But things can happen if anything did get damaged or was shut down improperly, or anything did get itself physically damaged by water, electrical relays, generators, whatnots that would then have to be replaced. That would be a whole nother matter entirely. Do you have a sense of have we had a refinery actually fully damaged by flooding before? Do we have anything to go back on here?
I suppose the analogs would be Rita and Katrina, especially Rita. I think there's more refinery damage, and a matter of fact, the same area, Beaumont and Port Arthur, with Rita. Now, I think reportedly they'd actually try to build more robust, dikes, levees around the refineries for better flood control. But this thing was such an enormous rain event that apparently it completely overwhelmed them. So I don't recall how long it took them to come back after Rita, but that would probably be the best guide, for how long it take to come back after Harvey.
All right. Well, it's not just the United States that's impacted here as well. The United States, and particularly that region of Texas, has become very dominant in the global energy market. I understand that the Houston area is now involved in shipping daily out some 8 million barrels a day of refined product, plus a little bit of what we're calling crude, but we can quibble over what's actually being put in those tankers, whether that light stuff that's coming out of the shale fields, we'll call that crude. But at any rate, we are shipping 8 million barrels a day. That's apparently all stopped for the moment. I did a little tanker count on the little tanker count website, saw about 30 just parked off of the Houston port. They're not moving. So this is going to probably throw a few wrenches into the global energy markets. In particular, I understand Mexico gets a lot of its gasoline from those refineries on that coast, and so that's shut off now. Do you think we're going to start reading about reports in Mexico of shortages?
I don't know. What the big question is, to what extent they can find gasoline elsewhere. I assume they'll probably be redirecting a lot of cargoes from Europe. Mm-hmm. However, I would guess that there's not going to be sufficient supply to completely make up for the shortfall of supplies from the U.S. And in addition, you've got a significantly longer transit time.
Well, I'm sure they're probably firing up as many of these cargo vessels as they can, certainly also aiming them towards the east coast of the United States. But even if you come from those refineries in Europe, you're probably, let's max those tankers out. What are we going, 14 knots?
Yeah, it's probably off back envelope calculation. I'd guess it probably takes 2 to 3 times longer than the U.S. to Mexico. Yeah.
So there's just a little spot here to manage. Now the real question is how quickly these things come back online. We don't really know. I've heard good reports that there doesn't seem to be too many commercial outages of electricity. I was kind of surprised. I thought a few substations might get taken out, but just help people understand. You live in Texas. People who maybe don't understand Corpus Christi to that Beaumont Port Arthur. How long of a stretch is that in miles?
Yeah, it's 322 miles, and it's such an unusual storm because as you know, the typical hurricane path is a linear or curving path, but basically primarily a linear trend. It hits a coast, it's very concentrated in that area, and then you got flooding rains along the path going inland. This thing hit just northeast of Corpus, did heavy damage to the small towns north of Corpus, and then moved slightly in, stagnated, and then backed up into the Gulf, and then drifted farther northeast. So this entire time period, Houston was just getting this, the dirty side of the hurricane, just wave after wave after wave of rain. And then as it moved farther up the coast, then Beaumont Port Arthur was getting the same thing that Houston got. But actually, I think Beaumont Port Arthur had a more intense 24-hour rain period than Houston did.
And they got clocked on the second pass of Harvey after he backed out into the Gulf and came back in for, what was that, the third time, or however many times it had been, but certainly
second time to hit the U.S. I think it was a previous landfall in Mexico or something.
Yeah, that was it.
Landfall.
Yeah, so they just got clocked again. I think they got something obscene, 20 some inches in a single 24-hour period after already being drenched on the first pass. So
so this bizarre storm basically shut in, the entire Gulf Coast refining capacity from Corpus Christi to Beaumont to Port Arthur. So it's, the Corpus will be the first to come back, and then the Houston ship channel area second, and then Beaumont Port Arthur presumably the last to come back.
Now, you mentioned it already. This is happening right at the start of probably the most gasoline-intensive weekend on the calendar, Labor Day weekend. That's certainly going to exacerbate things a bit, we would think, right?
Yeah, and one thing that kind of frankly shocked me is I would have expected the governor to ask people to curtail non-essential driving in order to maintain avoid reducing the gasoline inventory we've got.
Yeah, that would have been a good call. Hasn't
I guess didn't want to have a negative impact on business, but this really is a kind of a state crisis situation. I mean, certainly state crisis, as far as the damage and the flooding and the impact and incredible impact, but it's definitely a short-term, gasoline supply problem.
Mm-hmm. Mm-hmm. Well, so we know that this the port too is closed, and that also has impacts well beyond the petroleum industry. Obviously, Houston's a very active port for all kinds of things moving in and out. And again, as of now, all the latest I've got is that Galveston, Houston port officials hope to restart limited ship movements, quote, soon. That's all we got right now, but certainly it's closed all major ship traffic as yet. And every day, of course, is just creating a logistics sort of bottleneck nightmare for a lot of companies out there. So that'll take a while to unravel, I guess.
Right.
Now, I heard as well that the Eagleford had been largely shut down. I was surprised by that because much of it lies sort of to the west and outside of where I thought Harvey was hitting. But a lot of reports came in, said that whole area had been shut down. Do you have any information for us on that?
Oh, nothing specific other than media reports, but a huge question is going to be to what degree those wells come back. In these very tight, low permeability reservoirs, they're kind of notorious for suffering long-term productivity declines if once they're shut in for a lengthy period of time.
And how would you define lengthy?
Well, days, weeks.
Mm-hmm.
These micro-Darcy permeability connections are easy to get very easy to become clogged and closed off. So you get a material decline in well productivity. if they're shut in for days, weeks period.
Mm-hmm.
But they're the whole infrastructure has been impacted. I'm sure you had an enormous number of roads washed out, a lot of road crossings, low water crossings underwater, a lot of flooded well locations. And then they've got to get the refineries back up and running, so there's a market for the crude oil.
Mm-hmm.
So it's got to get all the various pieces put back together, all the way from the tank battery, the roads, the tanker trucks may have some fair amount of difficulties, muddy as all the roads are.
Oh, that's true.
And then finally, get the refineries back up and running. And then at the end of the day, as I said, there's probably a real question of how strongly those wells come back online.
Well, that will be fascinating. I know it's just a bad time for a lot of the shale operators to suffer any sort of a reversal of fortunes, many of them sort of hanging on, as it were, with low profitability as it is. So in that region, in particular, I think we would expect to, every day I've heard that it's shut down is roughly 800 million of revenue that's not flowing to those same companies who are all revenue starved. Is there any sort of a force majeure provision that can help these companies out? I know the Dallas Fed did them a real solid favor. I think it was in January, where they allowed banks to skip the whole mark-to-market thing on select energy firm debt that the banks were holding. Do you suspect there's going to be some sort of a I wouldn't call it a bailout. Do you think there's some relief coming here?
I seriously doubt it. I think the only place where force majeure might come into play is in regard to lease requirements, where they're required to drill a well
Mm-hmm.
or maintain a certain level of production. I think they probably have a good case for invoking force majeure there.
Yeah.
But I seriously doubt they'd be successful in getting any kind of government aid.
All right. Well, let's turn now to the wider part of this story. In your area of deepest expertise, you've been writing about the export land model. I would like you right now to, if you could, just a brief description of what that is for people who are not familiar with it yet.
Well, back circa 2005 or so, I started wondering what happens to the net export decline rate given a production decline in a net oil exporting country. And I simply hypothesized a simple little mathematical model, assumed a country with 2 million barrels of production, 1 million barrels a day of consumption, net exports of 1 million barrels a day, and then assumed a 5% fairly rapid decline rate, and assumed consumption kept increasing about 2.5% per year. And we just had an astronomical rate of decline in net exports. And so by the time that production fell to about 1.3 million barrels a day, net exports went to zero. And it's actually somewhat analogous to the inventory situation, because you assume let's say you got 2 million barrels a day of production, 1 million barrels a day of consumption, that's 1 million barrels a day of net exports. If you have a 25% drop in production, 500,000 barrels a day, that translates to a 50% drop in net exports. So you can only export what you don't consume. So you have a cut in production is a disproportionate decrease in net exports, and so that's very analogous to the inventory situation where I use example of a 23 million barrel decline in gasoline inventories against 230 is a 10% decline. But if you only got 45 million barrels usable inventory, that's basically half of a 10% decline in it. The gross inventory is a 50% cut in net available inventory. So it's basically the same math as an export model. That a decline in production has a disproportionate effect on net exports. And a simple way to state it is, given an ongoing and what is an inevitable decline in production in a net oil exporting country, unless they cut their consumption at the same rate as the rate of decline in production are at a faster rate. The rate of decline in net exports will exceed the rate of decline in production, and the net export decline rate will accelerate with time. Also, if consumption outpaces the rate of increase in production, you can have falling net exports even as production increases. And that's actually what we've been seeing in Saudi Arabia since 2005. They've been showing rising production, rising consumption, but their increase in consumption has outpaced the increase in production, and their net exports have been below the 2005 rate for 11 straight years through 2016.
Well, let's look at these specific countries again. I want to get to Saudi Arabia and Russia in just a second, but let's go to maybe some easier ones on the other end. Are there former exporting nations over this time frame you've been looking, former exporting nations that have now stopped exporting, maybe even become importers in this story?
Yeah, I use a model or a case history. I call it the 6-country case history. It's a major exporters that approached or hit zero net exports in a 30-year time period from 1980 to 2010. It's Indonesia, UK, Egypt, Vietnam, Argentina, and Malaysia. And I looked at it several different ways, and I've got a quantitative measure I call export capacity ratio, or ECI ratio. It's simply ratio of production consumption. And then look at production, consumption, net exports. From 1995 to 1999, the 6 countries showed increasing production, increasing consumption, small decline in net exports because consumption exceeded the rate of increase in production, and declining net exports. But in that 4-year period, as they showed increasing production, they shipped 54% of their total supply of post-1995 cumulative net exports. So again, production's increasing from 1995 to 1999, but in that 4-year time period, they shipped more than half of all the net exports that they would ever ship. And so that is analogous to Saudi Arabia currently, 2005 to 2016. But it's the only thing anybody ever pays any attention to is a top-line production number. Very few people even look at net exports. And what almost no one pays any attention to is depletion. These net export declines tend to be characterized by a ferocious rate of depletion in the early years of the net export decline period. And in fact, a rough but fairly consistent rule of thumb is if it takes 21 years to go to zero net exports, roughly 1/3 of the way, about 7 years into that net export decline period, they've already depleted half of their remaining supply of net exports.
So this is something that really bears mentioning. It's just such a powerful idea, which is everybody's looking at top line. Is there 98 million barrels? Is there 100 million? Whatever. What's the total gross output of the world? But for every country that's an importing nation, which, by the way, is pretty much every major industrialized nation at this point, what we care about in the industrialized nations is there any for export? I mean, I don't care if the world produces 100 million barrels if it also consumes 100 million barrels without exporting any, if I'm in a nation that needs to import 8, 9, 10 million barrels a day to keep going. So it's obviously the amount floating around on the surface of the ocean that matters a lot. And that's what everybody who's an importer is in competition for. And what the export land model says is, well, if you have these decline rates coming out of your reservoirs for whatever reason, and you've got increasing consumption, those two things are an exponential squeeze from the top and an exponential squeeze from the bottom, because those are on percentage terms usually. And so you put two exponentials together and you got x squared. It's times another number. It's a big ferocious decline. So let's put this in some context. This must be, I don't think the consumption's been increasing too much in Mexico. I think it's pretty flat the last time I looked, but they've had a pretty amazing decline rate in their output. They must be getting squeezed pretty hard at this point.
Yeah, their production peak was 2004, and they started declining after Cantarell went into a terminal decline. And they're down from, I think, roughly 3.8 million barrels a day in total petroleum liquids in 2004, I think, to down around 2.8 or so in 2016. They're down to 2.5. Yeah, they fell from about 3.8 in 2004 to 2.5 in 2016. Their net exports fell from 1.9 million barrels a day in 2004 to only about 600,000 barrels in 2016. If you look at their 2017 numbers, it looks like they may only average around 2.2 million barrels a day for 2017. And assuming no change in consumption, that's going to equate to about a 50% simple percentage decline year over year in net exports. And estimate that as of the end of this year, Mexico has probably shipped about 90% of their total post-2004 supply of cumulative net exports. So it's, Mexico, one of our chief sources of foreign crude oil. I think they've already shipped about 90% of what they're going to net export post-2004. Now, absent an increase in production, which is theoretically possible, they're certainly trying to bring in foreign investment. Mm-hmm. But personally, I think it's kind of iffy. Onshore, you've got pretty high operating costs. You've got a question of what kind of production sharing agreements are going to do. You've got a lot of corruption. You've got sky-high crime rates. And then on a macro basis, both onshore and offshore, you've got to remember that Mexico nationalized once. So, if they come in and get their production up, what's to prevent Mexico from nationalizing again? But, we shall see what happens.
Mm-hmm. Absolutely. So, yeah, all those risks, of course, apply to Mexico. And a lot of people have asked me, I was in Mexico City giving a seminar, 2 or 3 years ago. And a woman said, what's going to happen to the peso? It was about, I think at that point it was about 13 to the dollar or so. And I said, well, just look at this chart of exports over here and see the direction it's going. And the peso is supported by having this foreign currency flows, which would mostly in dollars. That helps the peso quite a bit. But if you can, unless and until you think their exports are going to turn around, my prediction would be the peso is going to continue to weaken. And what we saw with Egypt was I think they became a net energy importer for the first time 2010, 2011 was the Arab Spring. So these are really important things to track because I'm not saying it's, as soon as people run out of energy, you have an Arab Spring, but the pressures socially and politically suddenly mount all of a sudden because people are used to having this flow of funds and foreign money and hard currencies that enable them to do fancy things like, like Venezuela did with subsidizing gasoline or Egypt did with subsidizing bread or whatever you're going to do. But to your point, the ELM says, hey, as long as you understand where production is going and where consumption is going, you can understand that this is going to evolve a lot more quickly than most people are going to appreciate if they're just getting their news out of the newspaper.
Yeah, and that's once the production decline kicks in, again, unless they cut their consumption at the same rate, what you see is not an exponential decline rate. Exponential is 5%, 5%, 5%. A net export decline rate in virtually every case history I've looked at is an accelerating decline rate. Even Denmark, which has had a very successful effort curtailing their domestic liquids consumption, even Denmark has shown an accelerating net export decline rate because they were not successful in cutting petroleum consumption at the same rate that the production was falling. Production was falling faster than consumption. And even Denmark showed an accelerating rate of decline in net exports.
Wow. Yeah, and of course they're fantastically rich, but they better manage their sovereign wealth fund carefully. Good luck to them because they just announced they're going to start pouring a lot more on a percentage basis into stocks and equities. I think good luck with that given where we are in this particular equity cycle. We're rooting for you, Norway. So let's Let's widen this out just one more step, though. I've been writing about for a while the absolutely historic collapse in both upstream oil spending and in discoveries globally. 2014, 15, and 16 saw the lowest 3-year total for new discoveries in my data series. It goes back 70 years, maybe a little more than that. And of course, the world was a lot smaller 70 years ago and far less dependent on oil. My thesis, which is not too surprising, is that this lack of discoveries translates into future supply shortfalls. Not a really bold thesis, I understand, but there you have it. What are your thoughts on that data?
Well, I totally agree, and especially when you look at the composition of the post-2005 liquid supply. I think the most common dividing line between crude oil and condensate is 45 degrees API gravity. Below that is typically defined as crude oil. Above that is up to a higher level is condensate, which is basically natural gasoline. And what the EIA and most other agencies define as crude oil is actually a blend of crude plus condensate. But if you look at the available data, which is kind of sketchy, basically you have to rely on some U.S. data and some OPEC data, what the available data strongly suggests is that actual global crude oil production virtually stopped increasing in 2005. We may have hit about, I think it was 69 million barrels a day is what I estimated in 2005. We might have hit 70, 71 million barrels a day in 2016, which is a very slight increase over 2005. So in other words, if you look at the trillions of dollars spent on global upstream capex post-2005, all we were able to do is basically keep actual crude oil production, the stuff corresponding to the price indexes, from collapsing. What has increased is global natural gas production and associated liquids, condensate and natural gas. So my thesis is that increase in condensate natural gas liquids is obscuring, flatlining actual global crude oil production. And then you give this, tremendous shortfall, look at this tremendous shortfall in discoveries combined with the fall off in capex. And to me, that suggests a very strong probability of an actual ongoing material decline in real global crude oil production.
And so now let's connect the dots here. Tell us why those possible shortfalls and your ELM model come together into something that would be a perfect storm of its own.
Well, to return to Saudi Arabia, which is the world's largest net exporter, I think. I'm not sure the current numbers from Russia, but they've been on a sort of a little bit of a plateau below the 2005 rate. But once that production decline kicks in, you're going to see an accelerating rate of decline. And that's where the bidding wars are really going to get ferocious again. Another aspect of the global export supply situation is China and India, or the Chindia region. I've defined available net exports, or A&E, as global net exports less Chindia's imports. And I think it's valid because China and India have shown a multi-year recent history of increase in consumption in periods of high oil prices and periods of low oil prices. So the available data tend to suggest that what the Chindia region wants, the Chindia region gets. And if you subtract out their net imports, the volume of global net exports available to importers other than China and India, which is like 155 net oil importing countries, well, that volume of global net exports available to non-Chindia countries fell from 40 million barrels a day in 2005 to 33 million barrels a day last year.
Well, how are we making up the shortfalls?
Well, it was, that's where the U.S. came into play. Arguably, the world economy would be in a world of hurt right now if we hadn't had the huge increase in U.S. production post-2008. However, I think, as you pointed out in your excellent recent paper, a good deal of that production has been accompanied by cumulative negative cash flow. And so the question is how sustainable that model is. And one of the more remarkable things I've seen lately was the president of Pioneer Natural Resources complained about the quality of the wells they were getting in the Permian Basin and referred to them as train wreck wells that were far more complicated and far more difficult to complete than they had been anticipating. But if it had not been for that huge increase in U.S. production, I think the world economy would have been in a world of real hurt right now.
So somehow magically, thankfully, because the central banks rammed interest rates to a place where yield seekers had to go to all four corners of the world and also leave and suspend all disbelief at the doorstep. They if it weren't for that, I don't think it would have been possible. I can't think of any other industry. I'm scratching my head. Even Jeffrey, even like at the worst of the .com bubble, people only lost their senses for a year or two, right? Here, we've got an industry that's been burning cash in every possible price environment and cost environment and supply environment you can imagine. And so we're coming up on 10 years now, 10 full years of what I consider to be fairly simple accounting to run for a set of industries. A lot of smart people look at these numbers. I'm just confused because when you just run over to the cash flow statement and you take a peek at it and you discover negative cash flows in every possible environment, you have to say there's just something not right with this model. Something simply doesn't work here yet. So I'm confused by what people think, somewhere along the line is how this all turns around. But here we are. I happen to chalk some of this up to what happens in a bubble when you have way too much liquidity with too few things to do. It goes where it goes. But if we did have some sort of a return to much higher rates of cost of capital, or people decided to actually get an honest yield for their money, say, junk bonds that need to return, 12, 14, 16%, depending on the company. What do you think would happen to many of the shale operators if they had to operate under a much tighter financial environment?
Yeah, I think we'd quickly see, virtually overnight, some pretty dramatic declines in production. As you know, they basically have to run at a ferocious rate simply to stay in place. A few years ago, CD Research put the gross underlying decline rate from U.S. natural gas production about 24% per year. That would be the rate that production falls with no new wells added. So if you apply that to current gas production, it suggests that we need somewhere around 17 billion cubic feet, BCF, per day per year. What that means is that we have to put online the productive equivalent of Canada's natural gas production every single year. And on the well side, I think a plausible estimate that the gross underlying decline rate from U.S. oil production is probably around 15% per year, plus or minus, and probably increasing as a tight shale production accounts for a bigger percentage. But what that means is that we need to put online about 1.4 million barrels per day of new production every single year just to offset declines from existing wells. So roughly over 7 or 8 year time period, U.S. producers have to put online the current productive equivalent of Saudi Arabia's crude plus condensate production. So, say next 8 years, we have to put online the productive equivalent of Saudi Arabia's current oil production from these wells that have ferocious decline rates.
Well, that doesn't sound that hard. I'm doing some math in my head, and I'm going to make some wildly inaccurate numbers, but let's call that 20,000 new oil wells. And they're each 5 miles in length. So it's only 100,000 miles of drilling that we have to accomplish in order to get there. That's just over a third of the way to the moon. I don't know, Jeffrey. Seems doable. It really is insane, and for people listening, if you fly over these shale basin areas, you look out the window on a clear day and from your plane seat, you will notice that these things are require an extraordinary number of drill pad sites. I know they're stacking wells and doing all of that, so it's not 1-to-1 anymore, but it's an extraordinary amount of infrastructure, scraped land, sand, water, whatever they do with the stuff that blows back up out of the well after they've got this mystery blend of fracking compounds down there. It's really an extraordinarily intensive process, and to a point you made earlier, Jeffrey, which is that I last I heard it takes a single well might take 1,200 truckloads coming in and out, ferrying equipment, sand, materials, you name it, and just for a single well. It's such an extraordinary effort. Most people don't know this, and of course the headlines just say, United States has unlocked the shale mystery, and we're just the next Saudi Arabia. And even Donald Trump came out and said we're gonna be a net oil exporting nation soon, very quickly. Can you dispense with that one?
Yes, currently we're net importing about 42% of the crude oil that we process daily in U.S. refineries. I think our net crude oil imports are running around 7.2 million barrels per day against a crude plus condensate refinery input of around 17.2 or so prior to the hurricanes, of course. But that's we're dependent on net crude oil imports for 42% of what we process daily in U.S. refineries. So we'd have to boost, if we wanted to be just self-sufficient in crude oil over the next 8 years, pretty much round numbers, we would have to put online the productive equivalent of basically 2 Saudi Arabias. One Saudi Arabia to offset declines from existing wells, and then another Saudi Arabia to get us close to being self-sufficient.
So to the moon and back, then, probably. All right. Well, we're out of time at this point. As we wind up, are there any last comments about how people might consider preparing? Is there anything people should be doing at this point? It's probably too late for people in many regions to go out and stock up on gasoline without being hoarders in this particular case. What should people be thinking about here?
Well, probably, if what I would do is some advice to the governor, which would be to strongly advise people to curtail non-essential driving. It is, and hopefully will be a transient supply situation, at least as far as gasoline supplies, with a caveat that I think the big question mark, as we discussed, is going to be the status of the refineries in the Beaumont, Port Arthur area. But even having said that, if those are out, even worst case, if those are out for months, I think the markets can probably adjust about running the other refineries at close to 100% and shifting, and bringing more imported fuel. So, this would be is a transient situation, but the longer term picture, of course, is then you switch back and you've got a far more serious situation, I think, in regards to global supply in the context of the basic export math scenarios.
Mm-hmm. And of course, we'll have to watch how those Eagle Ford wells come back online, maybe for clues as to whether there's any lasting damage there, which might sort of ding the output to some extent. So with that, Jeffrey, thank you so much for your time today. Sure. Is there a place where people can follow your work?
Actually, I haven't written anything lately. I'll if you want to find any of my articles, you can probably just search for Jeffrey J. Brown and net oil exports. I think we'll take you to some of my previous articles.
Absolutely. Well, thank you so much for your time today, and I certainly hope it's transient in your area and that you don't have too much driving to do between now and when it all gets fixed. So thank you so much.
We're planning on staying put this Labor Day weekend.
Smart. Very smart. I am too. All right. Well, thank you.